A housing price crash is now guaranteed with higher mortgage interest rates on the horizon, right? That's what a lot of people are predicting, higher mortgage interest rates. Or is that whole thing just a myth? Do higher mortgage interest rates really correlate with sinking housing prices? Mortgage interest rates have climbed for months. They're expected to continue to do that next year. Well, rising interest rates, everyone knows that reduces house buying power and affordability. Prices have got to come down, right? Maybe they'll even fall hard. Well, by the end of this video, you are going to have a full explanation as to why and how. In fact, the last 6 times that mortgage interest rates rose, housing prices actually rose all 6 times. Hi, I'm Keith Weinhold. This is Get Rich Education. Look, could it be happening again? A few weeks ago, this Housing Wire article reported that there is a prediction from Fannie Mae that mortgage interest rates should rise and home prices are also predicted to rise in 2022. What, could it be happening a 7th time? Well, why would this be happening at all? Don't higher mortgage interest rates mean that prices have got to come down or at least stabilize? No. In fact, I used to think that that's what would happen, but that whole thing is a myth. Let's talk about why. I'm also going to talk about why higher mortgage interest rates correlate with a scarce supply. Yes, historically, the supply of housing falls even lower when mortgage interest rates rise. First, let's look at what happens with prices. Now, most people think that, well, of course, housing price power is reduced with higher mortgage interest rates because, look, with a $500,000 loan, just say that one has a 3% mortgage interest rate on it, and just rounding off what the mortgage payments would be, that's $2,120 at 3%. But if mortgage interest rates increase to 4%, well, that same $500K loan means that you have a payment of about $2,400. Well, that's a substantial increase, and to many they think, well, right there, that means housing prices have got to come down. Let's talk about why this is. First of all, let's understand that an interest rate is your cost of money. That's a way to think about it. Well, with the world awash in money like it is now, you would not expect to have to pay very much to borrow. There's less demand to borrow when the world is awash in dollars like it is now. See, not everyone's participating in this, but oftentimes the investor class is, but you feel more prosperous. Now, with the world awash in dollars, you might have received a stimulus check or a paycheck protection check last year, or you've seen the price of your stocks and mutual funds and ETFs rise, and the prices of your real estate rise substantially, and maybe even the price of your cryptocurrency rise substantially. Yes, the world is indeed awash in money. To make an analogy, just say that the world was awash in oranges and you had all these oranges, all this fruit that was really prosperous and plentiful in your life, and you're tired of eating oranges and you've got so many oranges, you're using it to make orange juice, and you're doing all kinds of weird things like baking orange rind into your cakes and all this crazy stuff because the world is awash in oranges. Well, you sure wouldn't pay very much for more oranges, or certainly to borrow oranges. Much like an Uber works with a rideshare, say that it's Sunday at 7 a.m. Well, there's not much demand for Uber seats because Uber seats are relatively plentiful, say Sunday at 7 a.m. There's not a whole lot of demand for them. But when Uber seats are a scarce commodity, say Friday at 5 p.m., when seemingly everyone wants a ride, you experience surge pricing in Uber seats. Well, it works much the same way with money. So the government, through the Fed, many expect them to taper the rate of dollar printing over the next few months. Less printing, making dollars more scarce, and then after the taper, they expect to raise interest rates. They call that process of raising interest rates lift off after the taper. So think about it, with dollars becoming more scarce, well, now you might be more likely to pay a higher interest rate in order to get a hold of some. Again, an interest rate is your cost of money. And when interest rates on money are low, like they are now, you've got to understand how you are less likely to save money in a traditional bank account because you can get almost no yield there when rates are low. Hey, go ahead and put a YouTube like on this if you would. That shows me that you like the material that's here. It makes it more likely that material like this will show up in your feed. And let's not make likes scarce. There's nothing scarce about clicking the like button. Well, with interest rates being low, making you less likely to save money and more likely to want to borrow money, what this does is it has bid up prices for all kinds of things when you're trying to get a yield somewhere and there's dollars all over the place. Well, that very act of bidding up prices, because there's so many dollars, that is inflationary, and it's a big part of the reason why we've seen inflation between 5 and 6% on a CPI basis, like I've discussed in a lot of my other videos lately. But getting back to mortgage rates increase when there is a positive economic outlook, because the economy can withstand higher rates. And that is a tool that the government uses to help keep inflation in check. With higher rates, you might be more likely to save money. People are less likely to bid up prices of things and put it out into the economy, and therefore prices don't get bid up nearly as much and inflation slows. So therefore, reducing the amount of dollars printed and raising interest rates is what the government does to keep inflation in check. The government doesn't want inflation to be too high for a lot of reasons, including the fact that you, the consumer, lose faith in the purchasing power of the dollar. So the reason that higher mortgage interest rates often correlate with higher prices is that when mortgage interest rates rise, what that does is the government has really validated that the economy is strong. That's the only way you can withstand paying a higher interest rate. It's validation that the economy is humming along. So here we go. Let's take a look at this. The last 6 times that mortgage interest rates rose, housing prices rose every time. Yeah, this chart is really key. I mean, the best way to predict the future is to go ahead and look at what really happened in history and see if we can draw a trajectory from the past into the future. You can see mortgage interest rates rose substantially 6 times since 1994. And yes, absolutely every one of those times with this Freddie Mac and First American Title Company data, yes, there was a corresponding rise in rates. Again, rising rates, rise in home prices, because rising rates validate that the economy is good. So this whole thing is a myth about how higher mortgage interest rates equal lower prices, even though it is kind of intuitive to think that way. Economies are complex. They don't just respond to one variable, and a lot of times it's not the variable that you think it was. Hey, if you haven't, go ahead and put a YouTube like on this. You must like learning something counterintuitive like this that really gets you thinking about how the economy works and how that intersects with real estate. I also told you earlier that higher mortgage interest rates correlate with a lower supply of housing. Now, why in the heck would that be? Well, actually, you know what? You already have the answer inside you, but you've just never asked yourself this question before. All right, say that mortgage interest rates are really low like they have been, and you are a homeowner, and you're paying a 3% mortgage interest rate. You're somewhat happy with your housing situation, like a lot of people are, but sometimes you're eyeing a move-up home. Well, look, now if mortgage interest rates jump from 3% up to 5%, how likely are you to move? You might still move, but you're less likely to move. Because now, just to get an equivalent replacement home, you would often have to pay more in a mortgage interest rate. So what happens when mortgage interest rates rise is people get somewhat more complacent. Fewer people move because they don't want to lose their low interest rate, and fewer homes therefore come onto the market. Fewer people list their homes. They're content to keep that low mortgage interest rate. That's why a higher mortgage interest rate environment correlates with lower supply, and lower supply, of course, correlates with, yes, even higher prices. So for a summary of what you've learned here, higher mortgage interest rates, which many feel are going to occur next year, they've already started ticking up over the past few months. Higher mortgage interest rates correlate with higher prices, and now you also know why higher mortgage interest rates correlate with lower supply. These aren't hypotheses, these aren't guesses, these aren't predictions. This is history, and it's what really happens. Hey, join me on the Get Rich Education audio podcast this coming Monday and every Monday. If you like learning about real estate investing, real estate economics, which is really what we've been talking about today, and wealth mindset. I'm bringing this wealth and this abundance mindset to real estate investing. All your financial heroes are with me on the Get Rich Education podcast. Everyone from Robert Kiyosaki to Grant Cardone and more. If you don't know about podcasts, download the Get Rich Education app. It's available for both Apple and Android. So go ahead and download Get Rich Education now. That way I'll talk to you next Monday. Hey, go ahead and put a comment below if you would. If you learn something about the counterintuition of the fact that higher mortgage interest rates correlate with higher housing prices, not lower housing prices. My name's Keith Weinhold. Thanks for being here, but you weren't here for me. You were here for you. We'll see you in the next video.